Hello, everyone. Today, we're going to talk about the 5 problems that will cut your retirement income in half. My name is Kathleen Vandenberg, and I'm an Infinite Banking Practitioner, a wealth insurance financial planner and advisor. I'm also a real estate investor, which makes my approach to things sometimes a little bit different. But today, let's get started with the problems that you have.
At IB Canada Group, we are your complete and independent source on the infinite banking concept, serving Canadians from coast to coast.
We're going to talk about why the assets that you will accumulate during your lifetime are not going to give you the income that you think in retirement. And it's all surrounding the problem of the safe withdrawal rate. And the 5 issues that we're going to cover are safe money, inflation, additional expenses, life expectancy, market volatility, and then we're going to talk about how to fix the problem and any additional benefits that we might want to cover briefly about the infinite banking solution. So let's get started. What is the safe withdrawal rate? The safe withdrawal rate is your problem. This is the amount that advisors will communicate to people like yourself at retirement to guide you as to how much you can live off of safely and not run out of money. Figuring out how much you can live off of in retirement isn't easy because there's a lot of unknowns. And we're going to cover the 5 major issues. But first, why don't you Google the safe withdrawal rate? You're going to see that the actual rate that they quote in the media is probably around 4 to 4.5%. And there's talk that it could be even lower. In the examples, I'm going to illustrate a 4% safe withdrawal rate. Let's get to the problems. The first problem is what I call the proportion of safe money. Now, in retirement, you are going to want to have a proportion of money in safe assets like GICs. But as you know, GICs are not a very attractive investment right now. 10-year GICs only earning like less than 2%, but it's completely irresponsible for an advisor or a person that's 70 or 80 to have 100% of their money in risky assets. It's completely, unfathomable to put somebody that's 70 or 80, 100% in equity or investment properties that are leveraged to 80%. I cannot tell you what the return will be on an infinite banking life insurance policy because, well, one, you can't tell me when you're going to die, but based on life expectancies, the return on the death benefit will likely be in the 6 to 8% rate of return. Now, it gets even better, and I'm going to get into that later. But basically, wouldn't it be amazing in retirement to have something that's yielding 4 times that what traditional safe money is yielding? So anyway, there's a lot more that it can do. But the bottom line is that you're going to want to have safe assets, right? Think about your father, your grandfather, when they were that age. They can't handle the risk and they don't want the risk and they don't want to lose money. They can't afford to wait. The second problem is inflation. Now, we're hearing so much about inflation lately. We're seeing that, or we're recognizing that the CPI index, consumer price index, is a big lie. In fact, many of the things that were in the index in the 60s are not even in the index now. If they were, inflation could be closer to 15%. You are going to want to have safe money, yes, but you need to have money that is inflation advantage, and traditional safe money like GICs are not. So we don't want to leave money on the table, but inflation and what it will do to your retirement income is one of the reasons that you can only take a little bit, that 4% of the value of your money. Just how much will inflation eat away at your money? If we look at $100,000, let's say you're taking an income of $100,000 and 2% inflation, we can see in 20 years that 100,000 is really only providing you the purchasing power of 66%. So that's like a 34% loss. In 30 years of retirement, geez, it's almost half. Now, if inflation is worse, if it's, let's say, 5%, the numbers are even worse. That 100,000 at 20 years is only going to be worth 35,000. That's a 65% loss. And at 30 years, it's close to an 80% loss. So you must have assets that are what we call inflation friendly, non-traditional assets. The third problem is additional expenses. I don't know how old you are. I'm in my mid 50s, and I can remember a time where, like, in our family home, we had one car, we had one phone. I shared a room with my sister. The cars had crank windows. There was no such thing as internet. That world is gone. You cannot buy a car with crank windows now, right? Lifestyle and life improvements only go up. And I do not know what the future will hold. I couldn't have envisioned, in my teens that my world would look like this, there'd be a TV in every room and everyone would have individual phones and my car would have a computer in it. My phone would be a computer. All I know is in the future, lifestyle expenses and lifestyle will only increase. For instance, I cannot wait to get rid of these glasses. And if I can buy new eyes, which I will at some point, right? You can go in and get corrective surgery or whatever, new eyes. I will do that. It's hard to imagine that we will have flying cars, but I'm hearing more and more about it. When I was a kid, I watched the Jetsons and they had flying vehicles then, of course they were in space, but I just think that we need to create a plan that has optimum wealth, and the infinite banking policies help to provide that. So again, I don't know what those additional expenses are, but I know that the cost of living will increase, and 20 to 30 years of time, there'll be certainly lots of advances. And so we want to create the money for it. And if we don't, or we need these things, that's why we have to lower our income to that safe withdrawal rate. The fourth thing is life expectancy. What exactly is life expectancy? I'm in the insurance world, we always talk about that. So let's say your life expectancy is 85, but what does that mean? That means there's a 50% chance that you will live beyond 85 and a 50% chance that you won't. So as you are sitting down at 60, 65 and planning, you'll be saying to yourself, am I one of those people that will live to 100, or am I only going to make it to the average life expectancy? But you don't know. So what you end up doing is planning to age 100, which means you have to live off of significantly less money because you need to make your money last to age 100. What we do with infinite banking policies is we create a world where you could actually, let's say, spend down your assets to your life expectancy at 85 and have the infinite banking policy replace that money. Because the way infinite banking policies work is the longer you're in them, the more they grow in the cash values that you can access, right? It's exponential growth. So again, we want tax advantage, exponential growth, inflation advantage types of products in our retirement. The fifth thing is market volatility, or even investment volatility. I think so often we think of market volatility as stock related, but it can definitely be real estate related as well. I want you to envision a world where, let's say you have $1 million and you're taking out 10% of your money, so $100,000, and there is a 30% drop in your investments, whether real estate, stock market, doesn't matter. If you're taking out that same 100,000, because that's what you need to live on your lifestyle, that 100,000 has moved from 10% of your money to now 14% of your money. So you can see how that will encroach on capital so much quicker and won't last as long. When you're in the accumulation years and the market has a pullback, you can be paid to wait. You can wait for it to rebound because you're not withdrawing. But when you're withdrawing from it, when you're in the payout phase of your life, you're going to need to take a larger percentage of your money in every pullback. So with the infinite banking policies, what we can do is we can we can withdraw instead from our policies and allow our investments to rebound. So most of the people, before they work with an infinite banking specialist, are on what I call the asset only trajectory. So for every $1 million they save, they really can only access about 4%, which is $40,000. What we are trying to achieve is an income that could be twice that. So maybe for every $1 million you save, because you funded your infinite banking policy, you only get to 800,000. But in this world, you can withdraw 10% of your money, which is 80,000. You see how I have created twice the income. But how can I do this with less money? Because in this world, when something bad happens, you can go to the insurance policy. What I want for you in retirement is you will not be forced to have a proportion of your safe money in GICs. Your infinite banking will be your proportion of safe money. And so you don't need to have a big chunk of money earning only 2%. You can have equity investments and real estate investments. But when something wrong happens, if there's a pullback, or you have a non-paying tenant, or you can't refinance, you can go to the insurance policy and allow your investments to rebound. You will not be forced to pull it out when there is depressed values. So that really covers the 5 problems, but it actually gets even better with these infinite banking policies. These policies are truly the and asset. We talked about how it saves your retirement and how the return based on life expectancy is around 6 to 8%. But because you can access the cash values during your lifetime, these policies are truly the and asset. You can do both insurance and not invest in other assets, because you can access the cash values during your lifetime for wealth strategies. You are not locked out of your wealth. It's an amazing, safe warehouse store of wealth, safe money, and it's completely uncorrelated to other assets. It's amazing, for instance, if you saw a stock market pullback, that you have this other asset that's not related to the stock market that could allow you to borrow against to invest. Or maybe you are a real estate investor and real estate becomes depressed and you want to buy more, but your other assets are also depressed because they're in real estate, but you have this non-correlated asset. It's this amazing line of credit that you have a contractual right to access. There is no application. There's a form to fill out to request it, of course, but there's no application. There's no proof of income. It doesn't hit your credit score. The loan on the policy does not hit your credit score. You have no obligation to even make the interest payments. It's this amazing tool, and it's very much, I talk a lot making an analogy to a property with a big line of credit, and the property is guaranteed to go up because infinite banking policies can only increase in cash value and death benefit. And then the line of credit is guaranteed to be accessible. You can access 90% of the cash values of the policies. So really, these infinite banking policies are amazing tools. I talked about how they're amazing in retirement, but they're also amazing during your wealth building years. They give you the insurance that you want and need, and you can borrow against the policies, collateralize it, and the interest is deductible if it's used for wealth strategies as well. A complete replacement for that safe portion fixed income money and an amazing non-correlated asset. I talked already about how it helps you in retirement. It creates a world where you are not subject to that safe withdrawal rate. You have a much better rate of return from your safe money. It's inflation friendly in that it is a growing asset, it's contractually obligated to grow. With market volatility, it gives you that buffer of the cash value. And with life expectancy, if you live too long, that's okay because the cash values become increasingly higher and available to you. So it's an amazing asset that you access through a collateral loan process. And then, of course, last but not least, it's an insurance policy, so it helps at death. It's really providing cash to the people that you want or charities that you want when they need it. It's a tax-free benefit to them, and it can offset capital gains, for instance, if you want children to inherit properties or you want them to take over the cottage. So it's cash when they need it. But again, you have access to the cash during your lifetime. You don't have to die to be able to access some of the cash values, but the death benefit is available, obviously. That really concludes the 5 reasons, the 5 problems, the 5 risks that can cut your retirement income in half, and how an infinite banking policy can help with that. I encourage you to go to the website here, ibccanadagroup.com, and contact us through that medium to access an infinite banking practitioner that can look at your particular situation and design a particular policy that's structured for you and show you in more detail all that an infinite banking policy can do for you. I thank you for your time and good luck with your wealth trajectory.
IB Canada Group, your independent authority for information on the infinite banking concept.